Happy Thanksgiving. So I have my third model is the Black-Scholes option pricing model. So if you want a copy, email me. The first model I came out with was the DCF, which is the model I use almost every video. The second model I did was the dividend discount model. So now the Black-Scholes. I don't know what I'm going to come out with next because it's hard to come up with different models. I think maybe I'll do an Excel file with like all the ratios, like to calculate like current ratio, ROE, just input like the items on the income statement. Wait, let me fix the view. I don't think I'm in the wrong view. Hey, Red Chip, happy Thanksgiving. Thanks for being a member, my newest member. So I just made a video. It's pretty straightforward how to input data into this model. I use Tesla because you really need a volatile stock for options. You can't pick like a stock like AT&T. You're never going to make money with options because the stock doesn't move much. Especially stocks that pay high dividend. They generally don't have much upside and downside. They're pretty steady. But Tesla's a good example. So so in the video I just did, I'll just do the same example, but we could do other tickers. So you just got to enter these values here, and then it gives you the option, the price of the option. So the current stock price, it's about 333, Tesla's current stock price. And then the exercise price. So if you go to the options, I'm in options. You can you got to pick the date first. So this is November 29th. So that expires tomorrow. You go out of however far you want. I just went out to December 2025, so it's like one full year. But you can really do whatever you want. The risk-free rate, I got it from this website, the 10-year Treasury rate, U.S. Treasury rate. So that's 4.25%. So I'm using that as my risk-free rate. That could change. Expected life of option. So we're doing a 1-year option. But like I said, you could do whatever time frame you want. Beta, that's dependent on the stock. That's how volatile the stock is. So if you go to most websites will give you beta. So it's pretty high, 2.8. So 2.8. And then the dividend. They don't pay a dividend. So 280 is actually in the money. And it cost $105 if you wanted to buy this option. And that's the price of it, 75. So I guess in this example, you would not buy the option because you wouldn't want to overpay for the option. So you could just keep plugging in different variables and try to find an option that's undervalued. And you're more likely to find an option undervalued than a stock undervalued because options don't trade much. So if any examples of a stock we can calculate the options for. Let's see how far out it goes. January 2027. So that's like, well, we're 2024, right? So that's like 3 years out. That's pretty far out. Let's do some. I'm going to pick way in the money options. $5 strike price. And that's, we're 2024, so it's 2 years out. It's like 2.1 years. Oh, this is actually trading exactly where the market's at. The price of the option's 328, and it is trading exactly at that point. That's pretty interesting. Let's do really out of the money. So we'll go at 700. So the exercise price, we'll do the 710, the highest one. So I'm doing right here, 710. That's $4. And it's trading at 45. So it's really not worth much. Because it's so far out the money, I guess it's so unlikely that Tesla will double, even in 2 years. It's actually not a bad trade. But the problem is it's so long dated, it's over 2 years. So there's so much time for that to happen. So if you want to maximize your profits, if you were psychic, of course, to maximize your profits, you would get the shortest dated options. Because like if you knew, of course you don't know this, like if you knew a stock would go up like triple over the next month, or go down 90% over the next month, like if you had some type of inside information like that, and you played options, you can make, millions. But you just don't know, like if you think a stock will triple and it does triple, but it takes 5 years to triple, you can't make any money with options. It has to be, you have to time it right. That's the really hard part with options. So yeah, I just did this video. Let me know if there's any tickers, and we could run this model with those tickers and see if we can get a good value. It's a little hard to explain how the model works, but you can look at the formula. I'm happy to send it to you. It's a pretty I guess straightforward Black-Scholes model. I mean, it's kind of like a DCF. It's all the same. There's some like slight nuances to these models, but they pretty much follow the same type of formula. But you can see, let's do something a little normal. Let's do a half year out, and let's say it's trading at 333. Say we want to do $400 options. So you can see, like, once you raise the beta, the option gets more valuable. See, it goes up to $26 because the more volatile stock is, the better it is for options. Like if you have a beta of 1, it's worth nothing because the stock barely moves. PDD. I guess they have options on every stock, right? Okay. Let's do the same thing. Let's pick December. So 1 year. When you do options, you want a little breathing room. I mean, you don't want like them to expire next week. You really have no time. Because if you invest in a stock and after 2 years you're down on that stock, and then the following year the stock triples, you're happy. Even though it took 2 years to triple, it's fine. But you got to hold it. You can't get rid of the stock. But with options, it's really a timing thing. You can't, if you time it wrong, even if a stock triples, you can't hold an option forever because you just lose all the value. There's so much decay risk. Okay, what's it trading at? $99. So you want to put the current price here. Let's go. Well, it's really, okay, we'll do the 104. It's only $5. Risk-free rate. What's the beta? Let's get the beta. .5. It's a really low beta. Do they pay a dividend? No. Risk-free rate. The thing is, I guess it's a Chinese stock. You can still use the U.S. risk-free rate. There's a lot of activity, a few thousand volume. So this is saying the option is worth $1.66, and it's only trading between 5 cents and 10 cents. It's a real big drop off. PDD. Oh, that's why. I was wondering. It didn't look right. Because I picked November 29th options, which is tomorrow. Okay. That's why. Okay. Let me do the right one. Because I was like, how can options cost 5 cents? I just picked the wrong date. That's a problem. Like if the options expire, I pick tomorrow, then there's really no time. I mean, the market's closed. Okay, here's the December 2025 options. Okay. So we'll do the 125. Expected life is 1 year, beta is 0.5. It was such a low beta, it's worth nothing, the option. If the beta was a little higher, and once you get a real low beta, I'm surprised it's so low, the beta. I wish there was a way to view it. Okay. So PDD. Oh, here it is. Okay, so it IPO'd in 2018 at $20. The peak was 200 in 2021. I remember it came down a lot, so it got down to like around 40. It never got back to IPO price. It ran up to 150. It's been coming down a lot. It's down to 100. Could you do car as an example? Yeah, with such a low beta, it doesn't really, it's hard to make much with options. But the stock isn't like flat, so I'm surprised the beta is so low. But that's what it is. Car, Carrier Global. $77, 1.2 beta. Car. Options. Huh. Oh, we could do September 2025. So we're in December 2024. So it's like 0.8 years, something like that. Exercise price, we'll do 90. So let's just raise the beta. So if the risk-free rate goes up, put up to 12, then the option goes up. And the risk-free rate goes down, the option goes down. Betas, does this pay a dividend? I guess beta has the most okay, 1% yield. Let me just make sure. Yeah, 1% yield. Call versus put matter on this calculator. And this is really for calls. But I guess we could try puts to see what the result is. Yeah, it's just calls. I'd have to change the model. Okay, so $90 exercise price. Expected life. Yeah, the more time you have, the more value, the higher the option is. Because when you have a limited amount of time, it makes the option almost worthless. Because you have to time. It's really hard with options because you really have to time it right. Because even if you identify a stock that's over or undervalued, that doesn't mean you're going to make money. You have to get it in the right time frame. So That's why I hate options, because it never seems like it's a good value. It's a total gamble. You have to understand that when you buy options, even a lot of stocks too, it's somewhat of a gamble. I mean, you make educated guesses, of course, but it's not like buying a bond. A bond is not really a gamble. Also, a pretty secure company like Coca-Cola is not a gamble, but there's some risk involved with a stock. In the market, if there's a market crash, even great stocks are going to go down 50%. So this option is trading. You see how wide the bid-ask spread is? 250 bids and 620 asks. Like, that's just crazy to think about it. Bid is how much someone wants to pay for the option. So someone wants to pay $2.50 for the option, and someone's asking $6.20 for the option. So it's just such a wide range. Like, if you ever see the bid-ask spread on a stock, it's like 1 penny or 2 pennies. Do they even have it? Okay, here. The bid it's 5 cents. The bid is 76.87. The ask is 76.92. I mean, that's such a tight range. 5 cents, and the stock is $77. So it's like 0.05 over 77. So it's 0.06%. The range. That's the kind of volatility, 0.06%. This is $3.70. So it's 148% volatility on the low side and 60% volatility on the high side. I mean, it's massive volatility, right? You get eaten by the theta. It's true. That's why. I mean, I've definitely done options. I actually did one a couple of weeks ago. I'm already down like 60% on the trade. Did you get killed? Because like, if you I should pull up my options. You'll see what I mean. If you buy a $20 stock, so that's today. You buy a $20 stock, and let's say in 1 month it's 15. So you're down 25%. Damn it. Okay. But let's say you same exact stock, but you bought options instead. And let's say you did 6-month options. If the stock went from 20 to 15, you're probably down like 60% on a stock, even though the stock went down 25%. It's so much more levered. I'd only do this with industry information about the future before the market realized it. I work in HVAC. My best options were oil companies in 2021. I mean, if you are able to, that's what Roaring Kitty did, though. If you can time it right, you could make enormous amount of money. Like, if you only have like $10K to invest, unless you picked Nvidia, then you'd have $3 million, but you'd have to pick the most undervalued stock at the perfect time and hold it for the right amount of time, which is so hard to do. But if you have 10K, even if stock goes up double, even if it doubles, you could turn 10K into 150K. If you time it, like if it doubles, say in a 3-4 month time frame, even if it comes right back down, like you can, like a $20 stock, if it goes to 40, say in a month, on a regular investment, you double your money, right? But with options, you could like 5x your money or 6x your money. But a lot of it is the volatility too. If you pick a stock, like that PDD with a really low beta, you could clean up because it's the chances of that doubling in a month are like so low. But if you pick a stock, a really high beta, a really volatile stock, you're not going to get as good of a deal. Ron Kitty's wife is like an investment banker at Goldman. Oh, yeah, I think I heard something like that. But he was I think he's like a CFA, and he was a trader, right? At I don't forget what company, but he's a pretty pretty established person before he. I think he's a CFA, maybe not CFA, but he's an MBA. But I know he has a good background. He's not like just some idiot that got lucky. He is CFA. Okay, he was a CFA, but they probably kicked him out because he's kind of like, I mean, he didn't do anything illegal, but it's kind of like, it's really borderline what he did. He was a CFA, but he no longer appears in a CFA. He was licensed security broker, registered with FINRA. Now it doesn't matter. I mean, he has so much money. He doesn't need that. He married his wife, Caroline, in 2016. According to testimony for Congress, Gil is... Yeah, it doesn't talk... It doesn't mention if she's... Not that it matters, but... Gil was named Indoor Athlete of the Year in 2008. Wow, he ran a mile in 4:03. That's really good. I was just looking. I think my best mile is like 6.5 minutes. I think I just beat 7 minutes in the past. But I'm not that fast. I used to do long distance. I did a marathon once. Because, no woman has ever ran a 4-minute mile. Not one woman has ever done that. My best mile was 5 minutes by car. Nice. That's pretty slow car. I mean, you should be doing a mile a minute if you drive 60. That's if you just drive 60, which is kind of slow, right? I probably did a mile in 30 seconds on the highway because when I used to go to college, I lived in Staten Island, which is New York City area, and I went to Buffalo to college. So I would always leave at I think 2 in the morning because I didn't want to hit any traffic. I just wanted to fly there. So I used to leave like a time when no one would be on the road, like at midnight or 1 a.m. So I could get there in 6 hours. So I remember I hit 120 in my car once. I don't know in kilometers, but I know 60 miles an hour is a mile a minute. So yeah, So if you go 97 kilometers, you did a mile a minute. Yeah, so it's about 100. Fastest female. Now, I just looked at it, and there's never been a woman. A woman has gotten to 1,500 meter in 4 minutes, but we're talking the mile, which is 1,600 meters. So the fastest woman is 4:07. I was kind of shocked when I saw this. The only reason I looked it up because I was on Facebook or something, and there was an article or a video about a girl in a woman in Britain who just broke the mile record. So, and I always knew the fastest mile, like, because I used to kind of follow that stuff. The fastest mile, by anyone. So it's like 3:44. So I was a little shocked a woman never did a 4 minute. Scott, Google the women time for a mile. Looks 4 minutes on Google. But it just shows you what psychology can do. Like, for the longest time, for centuries, the 4 minute mile, it was impossible. Like people said it's the human body cannot run 4 minutes mile. Like it's not possible until it happened. And then once it happened, then a lot of people started running 4 minute miles. But for the longest time, it was just considered impossible. So yeah, Roger Bannister, 1954. So it wasn't that long ago. So up until I'm sure once it got close to 4 minutes, people started thinking about it. But up until the early 1900s, it was just like it was put out there. If you were a runner, it was just expected. Like, you cannot physically, it's impossible. It's kind of like the 3 minute mile right now. Like if you say, if there's like a kid in high school who's been running his whole life, he knows you can't run a 3 minute mile. Like, if you're a human, you cannot do it. But that was a kind of like the thought process for the 4 minute mile. And that's just like, it's kind of like, once the psychological barrier is gone, then you could suddenly do it. Now, a ton of, so many people have done it. Like, probably thousands of guys have done it. Yeah, happy Thanksgiving. I'm from the U.S. Here in Switzerland, the max speed is 120 kilometers, which is low for Europe. Tuan, Grab, yeah, the delivery company, Grab Holdings. Is that's a British company, right? It's like DoorDash. Am I thinking of the right company? Grab. Oh, it's in Singapore. I was thinking of a different company, but it is like DoorDash, right? Oh, no, ride hailing. Okay. Yeah. Okay, now I remember. What was I thinking of? This might be, let's see, 0.2 beta, so it's not going to be good. I'm sure they don't pay a dividend. Let's go as far out as we can. Not many options, no pun intended. That's why you want to do a limit order if you do options, because they're so volatile. Like, when I buy regular stocks, I just do a market order. Whatever it's trading at, I buy it at. This is the 3 years. Okay, so it's not that bad as I thought. Okay, so if you go really deep in the money, look at it. It's trading. It's almost exactly where it last traded at. This shows you this calculator is pretty good. Look at the value of this option when I put in all the parameters is 474. Look what its last price was, 475. Let's go really outside the money to $10. Then it has no value. Yeah, once you go really outside the money, you guys know what I mean. I think some of you know what I mean when I say in the money, out the money. If you're really in the money, the option has value from day one. Let's go a little in the money. Let's go to $3. It's worth $266, and it's trading at. It is trading in that range, $220 to $295. I'm surprised how the beta. I guess when you're in the money, the beta has less effect on the stock. It's interesting. Email me if you want to copy this. You should just totally plug in the calculations in here. It's a hidden cell. So the calculation, a lot of the calculations are behind the scenes here. But the actual math is you take the current stock price, you multiply it by C21, which is an if statement based off of 3 parameters. It's hard to explain without it sound confusing. Over the EXP function. When you explain like what an asset is, that makes sense. But trying to explain options, because you have to explain derivatives and calculus, it's not that straightforward. So the EXP function is the inverse. The EXP function is the inverse of the natural log function. And the natural log, the constant E, is the exponential growth. Some people use just 2.718. That's what it's equal to. So this is a formula if you want to try to understand it better. I saw a Tasty Trade vid showing that typically selling cash covered puts outperform selling covered calls, at least when you aren't in the last decade. That is interesting. Selling cash covered puts. Let's try to unpack that if I can. Cash covered puts. So a call let's see how good I am at trying to explain this stuff. I don't remember what. What stock are we doing? Grab 518. Options are actually pretty straightforward once you understand the basics. It could get a little nuanced. So let's see if I could explain it. Okay. So the left side of the table is calls. The right side is puts. Let me change this so it visually. Because if you go to any website and you go to options, there's calls and puts. So on the left side of the red is calls, the right side is puts. So a call is given if you buy a call, like if you this is grab. What's it trading at? 520. So it's trading at 520 currently. So this screen is January 2027 call options. So if it's blue, on the left side, if it's blue, it's in the money. If it's not blue, it's out of the money. And on the right side, if it's blue, it's in the money. If it's not blue, it's outside the money. So generally, you want to buy something outside the money. So if you pick $10 call options, it's trading at 520. So it has to hit 10 just to get to the strike price. And then every dollar above 10, you benefit from it exponentially. So it's 80 to 90 cents. So usually you do the middle. So if you pay 85 cents, every contract is 100 shares. So it costs you $85 for one options contract at the $10 strike price. Okay. So you have to pay $85, and that money's gone. That just gives you the option to buy the stock at some point. So you probably wouldn't exercise the option until it broke through $10. I know you could trade the option in the open market, but I'm just going to keep it simple. So once it got to $11 a share, that was the price of grab. It has to happen before January 15th, 2027. So if you bought one option contract and the price did hit $11, you can sell the option and get $100. But you already pay 85, so you would make a $15 profit on this trade. But if you bought 10 contracts, you can make $915 on the trade. But every dollar above $10, you make. I mean, it just grows a lot. So say it hit $18, the stock price, you make almost $8,000, which is pretty good, right? For an $85 investment, you make $8,000. And as you go further out the money, it gets cheaper. You can see how expensive the options are. The bid is 220, the ask is 7. But once you get down here, it's under $1. And if you get further and further down, it's going to be like sometimes like 5 cents. So a put option is the opposite. That's everything on the right. That gives you the option to sell the stock at a certain price. So when you buy an option, you don't have to exercise it. You can just let it expire worthless if you're out of the money. But if you're in the money, well, let's get back to what you said. I just wanted to explain it in case anybody knows. So selling cash covered puts outperforms selling cash covered calls. So when you sell cash covered puts, because if you buy puts, you're bearish. So you're thinking it's going to go down in price, the stock. When you buy calls, you're bullish. Sell calls, you're bearish. When you buy puts, you're bullish. When you sell puts, well, let me fix that. Okay. You said selling cash covered puts. So when you sell puts, you're hoping the stock goes up. That's hard to believe that it outperforms. I guess I have to think about it more. It's just hard to imagine you hold the cash and agree to buy it if it goes down. I know my friend, he likes to buy puts on stocks he really likes. And if it goes down, he just collects his premium. But if it goes up, then he just buys a stock, which he would have anyways. So if a stock is trading at 100, what he does, he just buys puts. And if it goes down to 90, then he just he benefits because he didn't buy the stock at 100 and he collects some premium. But if it hits 110, like that's his strike price, 110, then he's just forced to buy it, which he would have anyway. But you said that's a hard name to say, Engineero. You said I sell covered calls and puts every single month. But when you sell covered calls, you're collecting a premium on the stock. So if it does go down, instead of losing, you're kind of mitigating your losses. Instead of losing so say the stock goes down like 10%. So instead of losing like $5K in paper losses, you lose $4K because you collect the premium. But it caps your upside, because what if like you have Nvidia or a stock that goes up so much and then it gets called away? I mean, you have to build that into your analysis, because if you just look at how much you get in premiums, but how much did you lose? Even if it gets called away once, that loss wipes out all the previous gains. The video is called "I Wish I Knew About This Metric 30 Years Ago." By the way, I got the term wrong. Cash secured puts. Yes, got the idea from Victor. Actually, we normally sell puts on stocks we are bullish on and wouldn't mind owning. Yeah, I'm with you. It's kind of like your. I feel like options, like when you sell covered calls, or what you're saying, buy covered puts, you're earning premium. So it's great if the stock is flat. If the stock doesn't move if you have a stock that doesn't move for years, you could still make money on the stock by selling covered calls. But like I got my stock called away once, and it just wiped out all the gains I had made in the past. Picking up a few $100s here and there. So usually it doesn't turn out to be that much money. The amount of we could use this as an example. So if you own the stock, it's trading at 520 today, and you sold January 2027 covered calls. So say you got the full $1.20, and if you owned 1,000 shares, so that's your value, is $5,200 worth of stock. So you can sell 10 covered call contracts at 750 strike. So this times 100 times 10. So that's how much premium you can earn if you own 1,000 shares of Grab and you wanted to sell covered calls, and you did January 2027 covered calls. So you could earn $1,200, but the shares are kind of locked up till January 2027. So if it goes down in price, then you might have saved a little money by doing this. And if it goes up a little bit in price to like $7, then it's great, because you got the upside from the stock, and you also got the $1,200 premium. But it's still like, if it went to $20, then you really lost out, because you only made $1,200 on the option on the premium. And if it crashes, it goes to like, if it goes to zero or really low, I mean, I guess you did mitigate some losses, but you would have been better off selling it. Yes, got the idea from secured, unsecured puts to cover calls. That's how you get rich. So that's how you get rich. Secured, unsecured puts to cover calls. I mean, I'd be interested in an example of someone who actually got rich from that. I mean, I know like I've done a lot of these trades, and when I cherry pick over like the past 25 years, if I always cherry pick like the 2 or 3 options trades I made a lot of money on, and I always say I did this and that, but I always neglect to say the 80 trades that didn't work out. And when you sum them all together, I probably didn't make any money on options. Like I remember once, do you remember Bear Stearns? The stock was like $2 because everybody thought they were going bankrupt, like Lehman. So I ended up buying options. I ended up buying the stock and buying covered calls, and I kind of regret it because I capped my upside. But they got acquired by JP Morgan, I think for $5, like a couple weeks later. So I made a nice return, but so I always talk about this trade. Secured cash puts, selling is great options. So you're saying, so instead, it's like the opposite of selling. A cover call is owning the stock while selling call options, but you're saying, watch the. I'll watch the video. Maybe it'll be better if I watch it. Okay, have a good night. Secured cash puts. Am I right? Is that just owning the stock while selling put options? A cash secured put is an option strategy in which you sell a put option on an asset while also setting aside the capital to buy the stock if you're assigned. Okay, so it's just having the funds there to cover. If you sell a put option, you may be forced to buy the stock at a certain price. So for Grab, so Grab is trading at 520, and if you sell puts, say at $10, well, say $10 strike price. Okay. Okay. So if you own a stock of 520 and you want to sell puts, so you're selling someone the right to sell you the stock. So you have to buy the stock. The strike is $10. What's the premium? It's a pretty wide range. Let's go to the premium is $350. Okay, contracts. So you have to pay somebody So if you sell, you need to use stocks with tight spreads. Yeah, I the bid ask last trade at $5. Wait, so how does this work? I can't, because when you buy a put, you receive the oh no, okay, I got it. So when you sell a put, okay, I'm back online. So if you sell a put option for this grab, you're selling someone the right to sell you the stock. So if you do one contract, you receive $350. If the price hits strike, so you have to buy it from somebody at a certain price. So it's good now. We lost your audio. Yeah, that happens. I don't know why. So you have to pay $10. Okay, that's what. No, it wouldn't be more than. So the premium would be $5. It wouldn't be this low. Okay, so you receive $500, and you have to pay $10 for the stock. If somebody forces you to. So if the stock goes up to like $18, you receive this premium. You receive how much dollars a premium for one contract. Now, if the stock price goes up, well, even if you're already in the money at this point, we probably shouldn't have picked something in the money. That's why it's getting, let's pick something out of the money, because a put, let's do $4. Okay, $4. And the premium is, the last was $211. Okay. So you hope it goes up, so you don't have to buy it. If it falls below the $4 strike price, I guess there's not much room. So even if it goes to like the worst case scenario, say it goes to $1, it could go to 0, but I guess that's the worst case scenario. You have to pay $4, even if it goes down to $1. So you have to pay, okay, price. Yeah, you only have to pay if the strike is 4, you don't have to. It has to fall below 4. So even if it hits $4, you don't do anything. But once it falls below 4, say it falls to 3, then you have to buy the shares. You have to pay out of pocket. You have to buy the shares at a $4 price, even though they're $3 each. So you lose $100. So you would have profited $111 in this case because you collected $211 premium. So the worst case scenario, goes to 0. And you lose $189, which isn't terrible. Yeah, you're assigned the shares, and you don't have to sell them right away. I'm just assuming you buy and sell. I mean, that's not bad, but I'm like, you have to secure it with cash. What's a good one with more? Maybe let's try Tesla. That seems to be a. Okay, so let's pick December 27th. Let's just. What's it trading at now? 333? 333. Okay, 333. Okay. So let's go. There's not much activity. Let's do 110. The 110 strike price. So it has to hit 110 for you to pay, for you to have to buy the shares. 6 cents the last time. So you make $6 because it's so unlikely to happen, right? What did I do? Okay. So you wouldn't pay anything until it hits below 110. So if it goes 200, okay. So if you you don't have to even own Tesla. Say you sold puts, cash secured puts, and Tesla's at 333. You sold 110, which is pretty far outside of money. So it has to hit 110. So say it hits 100, which is pretty unlikely. You would lose $1,000. You collect your $6 premium though, so you lose $9.94. So I am asset options trading, but it seems like, you know, it's such a low premium. You can't go, I guess, too far out to the money. Apple, okay, we'll do Apple because that's the thing. It's just the reward is so small. The risk, I guess you can't go so far out the money because, I mean, you could, but it's pretty unlikely to happen, right? Okay. So it's 234. So you do the 180 strike, and it's only what 2-3 months out, and the premium is like 12 cents. So if it gets, so you get a 600. If you sold 50 contracts, if it hits 150, you lose $150,000, but you do collect a $600 premium. If it hits 180, you're fine because it didn't get your strike price. So you got to, if you sell 50 contracts, yeah, I'm doing 50 contracts. Let's do 10 contracts. So you collect $120 in premium, and if it gets down to 170, you lose 10K minus your 120. So how do you make that much money? I understand making a few $100s here and there because it's so unlikely to happen. So, but if it ever does happen, you lose all the gains from, unless price drops to lower than 110, all $6. Yeah. Well, in this example, we're doing 180 for Apple. So you can't make any money on these stocks. It's just there's not enough volatility to ever make. I mean, you'll make a few $100s, and in an extreme situation, you'll lose $100,000. I don't see how you make even like a, you know, is it really? I mean, you can sell puts $220 a week. Yeah, I'm sure these stocks are probably not going to go down, but if there's a market crash, you lose your life savings. The premiums are just so low. I'll watch the video. It just doesn't make sense to me. No, I get that. You would have bought the stock anyway, so you're selling puts. But like I said, the extreme scenario, which only happens 1% of the time, is you would lose your life savings. But 99% of the time, you would make $500 or $1,000. I don't know. Any other examples of stocks to sell cash secure puts? No, you could buy back your options, but you still have to pay a hefty price. Like if you did the 180 strike price with Apple, you don't have to pay anything till it hits 180, and that's a far way because it's 234. So Apple would have to go down 50 points. But if it does get close to 180, it's going to be expensive to buy back those options. And if it definitely falls below 180, it's going to then you have to pay a lot, because once it's in the money, like you could see like 275, like once it gets in the money, then it gets pretty expensive to buy it back. And the deeper in the money, you can roll them forward. Right. You can push them forward another 6 months or a year and hope it moves, like the stock goes up in price. I get that. But you guys sound like it's a great investment. So I'll look into it more. It never makes sense to me, the math, but maybe I'm missing something. What's the name of the video? Tasty Trade with Tasty Trade. Too bad. If I play a YouTube video, can you guys? I don't think you can hear it. I think it turns off the volume. Well, here's a lot of subs, 420,000. Put option explained, buying and selling put options. Yeah, these people are really good at getting views. I really appreciate your deep dives. Oh yeah, sure. Thanks for the comment. I mean, I looked into it all. Like if there's a get rich quick scheme, I try to do a lot of those things, or I look into it, and they're just scams. I mean, it's not like like a real scam is like when those people try to pretend, like those people, like usually in Nigeria, they pretend they're somebody else and they make you fall in love with them, and then they ask for money. That's a real scam. So it's not like that type of scam, but it's like if somebody's really good at making money, it doesn't matter what it is. They don't have to sell you their idea for for $100 or $50. Like somebody who's really good at making money, like if you pick stocks like Warren Buffett, he'll never ever sell a course. He won't like spend all his energy trying to get you to buy his course. Just like if somebody's really good at like baseball, like a professional baseball player, he's not going to spend charge you $100 an hour to teach you. Like he would never waste that much time, because he can make millions. So generally, if somebody's really good at something and they make money with it, they don't need to convince you to buy their idea, because if they're really good at it, they don't need to. They can make so much money themselves. It's totally a two-edged sword. It's kind of like that whole thing with if you want to win $100 in a casino, And I've looked at it all, and the math just doesn't make sense. So I go, just bet on red, and let's just assume it's 50-50. Every single roulette wheel is 50% red, 50% black, even though we know it's not. It's like 49% red, 49% black, and 2% green, something like that. But let's just benefit of doubt, we'll pretend it's 50-50, which is better odds. So I could guarantee you, you can make $100 with my strategy. So we just do equals 1/2. No, 1/2 to the first power. So if it lands on red, it's 50-50. It's going to land on red. Then you're done. You get your $100 and you go home. And if it doesn't, then you do $200 on red. So you're 50-50, and the chances of losing both are only 25%. So there's a 75% chance you'll get at least one red on the first or one red on the second. But if you don't get it right after the second, you double up again. Because what are the odds of you losing 3 in a row at 50-50? It's only 30% chance you would lose. And there's a 88% chance of you winning. What are the odds you miss 4 in a row, 4 reds in a row? It's black 4 straight times. It's only 6% chance of going red and losing 4 straight times. So you have a 94% chance. So even if you lose the first, you double up on the second. If you hit the second, you're done. You get your 100 back from your original. But then they say, what if you do 5 in a row? The thing is, at some point, you're going to go bankrupt, because there will be situations you'll hit. There would be like, 7, 8 blacks in a row or reds in a row, and then you'll lose your whole bankroll. So it's kind of like that idea, like you could win a little, but you have to risk so much. Even though the chance of you losing your whole bankroll are only 1%, if you do this game every day, you're probably going to lose your whole bankroll every 20 days or something, which will wipe out all your winnings from the past. Because you'd be surprised how many, like, if you play 1,000 roulette spins, there's actually a handful of times you'd see 7 or 8 in a row, black or red. Like, it's not extremely rare, even though it's less than 1%. Like, if you play for 100 straight days, and you could start with whatever you want. You could start with $1,000 if that's your goal to win 1,000, but then you have to wager $500,000 on the 10th try, and you can't even wager $500,000 because there's a max bet on the roulette wheel. Maybe it's a 5,000 max bet. So there's no get rich quick scheme. It's just, I've looked into them all. That's all I thought about. And I looked at all the gambling. It's just, it never works. But I'm going to watch the video because I'm interested. It sounds like, and it's as simple as this. I know this is a extremely simplified example, but like if you hit 5 reds in a row, then you, like you said, oh, just push forward the contract. So instead of then I could just push it forward another month and go to the casino next month. But like, it doesn't change the math. Exactly. Just protect your capital. If you try to limit, you don't want to protect it too much. You can't put all your money in a savings account. That's silly. But if you put it all into the S&P 500, it's not. If the U.S. economy crashes and goes to zero, the stock market's the least of your worries. Like, being able to eat food, it'd be the Great Depression if that happens. But yeah, I'm definitely going to look into it. Even though I think I know the answer, but cash secured puts strategy. Cash secured put is option strategy, which you sell put option such as stock while also setting aside a capital. Okay. Can you also make money? How much do you lose on a cash secured put? Okay, yeah, and I'll do a video. But the problem is my videos don't get views because people don't want to hear how you can't get rich quick. They don't want to hear that. They don't want to hear that it's going to take 20, 30 years to accumulate a massive amount of money. They want to hear, like, tell me how to make $1 million this year. You could buy a hedged version of SPY, like, yeah, no, definitely. What, I don't know what you mean that buy a hedged version of SPY, KSPY. Why? To protect your downside? Is that what you mean? Or Crane shares hedged equity index KSPY. It's just owning the S&P 500. I don't understand what's the difference between that and S&P 500. I bet you it has a high fee rate. Yeah, you're paying 10 times the fees. Why would you pay 10 times? Like, what's the benefit? KSPY versus SPY. Because SPY is 3 basis points, right? Isn't it? Or maybe it's 4 basis points. So you're paying 15. 4 times 15 is 70. Yeah, you're paying 15 times the fees. It's an ETF of the SPY with lower volume, I think. I'm still not sure what it is. It tracks the S&P 500 with the objective of reducing volatility and dynamically hedging downside risk. Okay, so it's just limiting your downside. Yeah, I guess if you think the S&P 500 is too risky, no, they don't use options. Oh, they might use options to protect your downside, but they still just invest in the S&P 500. 98% of the money that goes into KSPI is invested in the S&P 500, but they don't talk about the options. I don't see any. Maybe in E-Trade they do. Okay, so go to portfolio. Okay, so it owns. Okay, so it does. These are the options. That's fine. I mean, if you think the S&P 500 is too risky, I don't think it's too risky. But if someone wants to invest in it and is concerned about downside, this is probably a good alternative. You get most of the upside with the thing is, when you hedge your downside, you're also hedging your upside. So in the long term, you're probably not going to make, you're probably going to lose money with this. But in a short term, in a year, you might benefit a lot from this. Yeah, so it's like if you invest $10,000 in the S&P 500, like if it triples in price, what was it, KSPI? What was it called? Yeah, KSPI. So if you bought 10,000 KSPI, you might end up with like 29,000. That's if it goes up. But if it goes way down, like if you time it wrong and you buy 10,000 and it goes down to 6,000, then this might go down to 7,000. So you save $1,000 by doing this. I don't know how much it protects downside though, but I can't imagine it. I mean, if there's a huge market crash, it's 98% invested in S&P 500, so it can't protect it like totally, of course, but okay, well, good stream. Email me if you want a copy of this options. I think I just saved over it. I probably shouldn't have saved over the file. I got to clean it up now. Models. I think version 2. Yeah, I saved. It doesn't matter. I always version 1. I just set it up so version 1 is the one I email to people, and then in version 2 is the one I update and play around with. I guess it doesn't matter. Okay, great. I enjoy your Thanksgiving, and most of you probably ate already, right? because I'm in West Coast, so it's only 4 o'clock here. But most of you probably ate. Okay, I'll talk to you later.